Hey there, welcome to today's lecture. This will be the second video, the lecture 2 of this series, and the title is why price is drawn to certain levels. This is a follow up on my first video, how that I spoke about IPDA, and there are some magnets that attract price. So I'm going to be doing a detailed video on what those magnets are. So these are what we call, as I said earlier, they are what I call price magnets. And if you are not trading with them in mind, you are probably getting caught by them instead. And as I've said earlier, the market is not random. It's actually structure, it's position. And once you begin to see that structure, you will stop feeling like the market is out to get you and start reading it with precision. So what I will cover in this video is the three things I mentioned in the last video, which is the first one, the liquidity zones, and then imbalances, and optima and institutional levels. If you have ever wondered why price feel like it's being pulled to certain levels, this lesson will give you the answers. These are the same tools that I use to interpret price myself, and they will form the foundation for everything we'll be doing moving forward. So let's get right into it. So back to the big picture again, which is this smart money concept, or what we can call the smart money paradigm. What's the idea again? And the idea is that markets aren't random, and they are controlled. They are structured, and they are actually heavily influenced by large institutions and algorithms. In the old days, prices were moved manually, by traders sitting in pits. Today, it's all automated by the algorithm. And these algorithms are time sensitive and price sensitive. They execute trades at specific moments. Okay. If you think about it, if you look at these markets that we trade on, they are actually created basically out of thin air. There is usually no, they are derivatives. It means they have no physical backing. They are not tied to any physical goods or products. Even markets that are tied to physical goods, real words, supply and demand, like oil, grain, and those other products, they are actually driven by mechanics. But derivatives like Forex, futures, cryptos, they have no physical backing or whatsoever. They are not tied to any physical good. So they are entirely algorithmic led. So what might look like chaos to a retail trader is actually something that is incredibly calculated. And the more you understand these forces, the more the market starts to look predictable. So like I said, these are derivatives. It means there are people setting the price based on the economic condition and so many other factors, which is how they used to set their price. Okay, so what is liquidity? So before diving into the price magnets, let's define what liquidity really is. Many don't actually know the meaning of that, and it simply means how easily an asset can be bought or sold without causing major change in price. High liquidity means trades can be executed with minimal impact. Low liquidity means fewer buyers and sellers, so price can be moved sharply. Let me give a simple explanation. Imagine selling ice cream on a hot day. You are the owner of the vendor, you are selling ice cream, and it's a very hot day, people really want it. So you have a lot of buyers around. So you can easily sell at near the normal price. You can even add a little bit of you know amount to it. And that's a liquid market because you have a lot of people willing to buy what you're selling. Now, but try selling, maybe you have a used bike or a used shoe or whatever with no one around, and you will likely have to drop the price to find the buyer. That is less liquid. And I think this is one of the things that people that create maybe albums or art with maybe we have one or two copies in the world, or you hear something like limited copies of maybe a song, album, something sold out. You see that with time the price of those assets will actually increase, because when people want them and they are scarce, it tends to increase the price. The person having it can sell it at any price. That is if there is a willing buyer. But imagine what you have is not something people really want. So it means because you want to sell it, you have to drop the price. So someone says, is that not the law of demand and supply? Maybe you watched my previous video and I said the market is not moved by demand and supply. Yes, that is true. So what I just described, is that not the law of demand and supply? It is also law of demand and supply. But is that what move price always? No. But can it move the price? Definitely. Let me put it better. I remember we are dealing with derivatives, and the demand and supply, which can move the price, are the ones done by institutions, not retails. And they happen at key levels, not every point in the market. Now, but the one I described earlier of someone selling ice cream, because you are the owner of the ice cream store, you get to determine the price. So the same way, these people are the owner of, I won't say the owner, but they are the market makers. They determine price. So they are the one in charge of it. So in trading, high liquidity means many buyers and sellers are ready at all price points. Then you think, does that mean that people are always buying and selling at every point? Of course not. That is why you have brokers and also market makers. These are the people that facilitate buy and sell. They are always willing to buy and sell at every point in time. So when you sell a market, it's not necessarily someone else buying from you. It could be the broker. So they facilitate, they quote both price of an asset at every point in time. I hope you understand that. So trades happen smoothly because of that. Now liquidity pools are now places on the chart, where a lot of those buyers or sellers are waiting. And those spots act like a magnet for price. When you have a lot of people waiting to buy, a lot of people waiting to sell at a particular point. So in trading, liquidity often sits in clusters, around stop losses, pending orders. The algorithm knows this. It knows where most traders hide their stops. It knows where volume will be sitting, waiting. That's why liquidity is the first magnet we need to talk about. Think of liquidity pool as a gathering spot for others. In practice, this often form just above recent swing highs or below recent swing lows on a chart. And retail traders love placing stop losses near recent swing points, whether to secure a profit or to reduce their losses or to lock some profits. And for example, stops for short trades sit just above a high, and stop for long trades sit just below a low. Recent ones. And when a stop order is triggered, it turns into a market order, providing liquidity. And big institutions want that liquidity, so they nudge price towards those cluster orders using the algorithm. Now, over time, this creates a pool of liquidity that algorithm can target. Now, above recent highs, you often find the buy side liquidity, that is the stop losses from sellers, and below recent lows you find a sell side liquidity as stops from buyers. And when price moves makes a sharp move into one of these areas and quickly reverses, it's not reacting to supply and demand, no. It's actually hunting liquidity, which is what we call liquidity trade or liquidity sweeping. And the algorithm is clearing our stops to free up volume for larger institutional trades. Now these pools acts like magnets once again, and the algorithm is designed to go after them. It's actually a way of engineering the next move. So what is swing high and what is swing low? Now a swing high occurs when there is a high with a lower high to the left and to the right, and a swing low occurs when there is a low with a higher low to the left and right. So that's what a swing high is, and that's what a swing low is. So here is buy side liquidity just above a recent swing high, and a sell side liquidity just below a recent swing low. This is an example of buy side liquidity and sell side liquidity. Okay, so liquidity pools. So what are those pools and how do we recognize them? So the common ones or the major liquidity pools are old highs, old lows. We also have relative equal highs, relative equal lows. Why is it called relative? Because it may not be exactly at the same point, but when they are close together, they are called relative equal. And one of those major pools is also previous week high and the previous week low. So if a week forms an high and a low, the next week will probably go for either the high first or either the low first. So then also previous daily high and previous daily low, also the same way, maybe yesterday, today's, or let's say the next day candle, we want to sweep the previous day high or the previous day low depending on the order flow of the market. So you also have the previous month high or the previous month low. Means the new month will probably target those level in the the new month will at one point in time target the highs created in the previous month or the low created in the previous month. Okay, so you also have session highs and lows. As probably might know, the markets has different sessions. You have the Asian, you have the London, and then you have the New York session majorly. So the Asian, the London, and the New York. So those sessions also have they create highs and lows. So the next session might target the previous high or low of the previous session depending on where the market is actually going towards. Okay, here is an example of Dow Jones, which is known as US 30 index. So if you look at my chart, you can see some labelings. So you have the New York NYPM is New York evening session. H is the high and the L is the low. The AS there is Asian high and the Asian low, which is the blue color. And the one in the red color would be the London high and the London low. The New York AM would be New York morning session high. New York AM low would be also New York morning session low, then followed by the New York launch high, New York launch low, and then the New York evening session high and evening session low, and that's how it repeats on a daily basis. The PDH there is the previous daily high, and the two day open, there is the midnight open. So all of these levels are the important levels that price navigates towards and where liquidity pools are sitting. So the same here, Thursday to Friday, see D open there is the daily open. Then through the open there refers to the midnight open. So PDH previous daily high, PDL is the previous daily low. So you see that price usually come towards those, either the session highs or lows, or the previous daily highs, or the previous daily lows. So and that's how it repeats on a daily basis. Right. So imbalances. Now these actually occur when the market reprices too aggressively, leaving behind a gap price area where there wasn't much trading. It's like a market actually skipped a gap. And this actually it's not actually repricing too aggressively, it's actually part of the coding, the engineering. It was designed to actually do that as well. I'll get to some other aspects of uh, liquidity, will explain that as well. I mean, that will be in some other videos. Okay, so when market reprice very quickly, is moving aggressively because it's going towards a place, that is when it does that. And it can be in form of fair value gaps, can have volume imbalances, or it can be opening gaps. But majorly I'll be talking about fair value gaps because that is the most common one. Alright, so what's a fair value gap? Well, you must probably have heard about this if you have been trading before. Fair value gap occurs when there's an empty space between the first and the third candle, three candle sequence. It's formed when the high or low of the number one candle they are seen on in the video doesn't overlap with the low or high of the third candle. So it creates basically a gap. The first one here is the bearish fair value gap. It's also known as CB, and that's the name ICT calls it, which is sell side imbalance and buy side inefficiency. Because that is, the imbalance is on the sell side, so it delivers price too aggressively on the sell side, where the buy side is inefficient, it does not deliver the buy side. So the second one is the bullish fair value gap, also known as BC. So buy side imbalance. The imbalance or the aggressive movement happen on the buy side, and the sell side is inefficient at that point. So price usually comes back to these levels is the algorithm engineers in such a way that price come back to those level. So if you create a bullish value gap, is to send price higher. So price most of the times comes back, retraces back into the gap before continuing higher, and bearish value gap, price usually returns there before resuming downward. So why do these gaps matter? You just have to look at the chart. Because the algorithm doesn't like unfinished business, so it returns to fill these gaps to rebalance the market. Over time, you start spotting them and watching price come back over and over again. It's quite easily to spot. This isn't just a theory, no. And watch out for them. These gaps are like holes in the market's logic, and the algorithms want to patch them. So it's not a question of if it will come back, it's a question of when it will come back. Remember that the algorithm works based on time and price. Here are some examples of that gaps on the market. This US 100, also known as US Tech, also known as Nasdaq. If you look at this, I think this is a 5-minute chart. See the fair value gap formed here, the price comes back into it almost at the middle of the gap, then rallies back up, creates another gap, price comes back into it, rallies back up, and the third one, price comes back into it, fills the gap, delivers the sell side now, and then continues back up. So you keep doing that until it gets to where he wants to get to, or where the institution are actually moving the price towards. Another one on the Nasdaq as well. See the same thing happen here. The gap price just taps into it, rallies back up, then leaves a series of gaps. All these gaps are places where price is definitely coming back to. Then uses this gap to rally again, leaves a bunch of gaps again, uses gap to go up again. So all these gaps that are left behind are opportunity for price or a reference point for price to actually come back to. So the third one, this is US 30, known as Dow Jones. So we see the same thing happening here. This happen on any market, almost any market where that works based on algorithm. So you see this as well. This is your 1 minute time frame. You see a gap, price keeps coming back, and then the gap keeps holding the price until the price is actually ready to move downward. Then create a new gap, sells, create a new gap, then have a bit of a consolidation here or accumulation, or what we can call engineering price. And then just before this massive sell, let me see what happened. Price goes up, clears all the liquidity here, and then from this gap, 1 minute gap, sell massively. Now this is just to take out people who are sold maybe on this previous candle. Someone who already sold here, and then the price sold, then the price moved downward, will have probably placed their stop loss above this high. You already see the price is moving. Then the right thing or your instinct will tell you to move your stop loss towards the high to protect your order. And then the market knows that, then clears out everybody, then immediately did a massive sell. Probably won't have opportunity to sell again before it delivers what it wants to do. When you see it again, comes back into the gap, sell a bit more to clear this low. So US 30 again, 1 minute time frame. You see price gives gap, ready to sell downward, then leaves this gap, then comes back to it again and did a massive sell to take out the sell side liquidity here before it then continues back upward using a series of gaps as well. So this is not just doesn't just occur on 1 minute or 5 minutes, it occurs on every time frame, be it daily, be it monthly, be it hourly, for hours, you will find it there. Alright, so this right here is an interesting one. So we see price comes, right, creates this gap, then keeps selling, creates gap, easy to sell, creates gap, easy to sell. Okay, I think I've shown this earlier, but I want to point out there is still liquidity sweep there. So you have a liquidity sweep, or what we can call total sweep. Then you see, then start creating fair value gaps again. This time it bullish fair value gaps, to take price upward, and then it fills the previous gaps that was not filled. So this is what we call smart money reversal. We'll learn more about that in some other videos. There are many things you just hear me say for now, but as you keep watching and stay tuned, you will learn more about them. So the last thing I want to talk about is the institutional levels or optimal pricing. So optimal pricing and institutional levels, these are price zones that the big players in the market movers, that's where they consider the ideal entry or exit points. Basically the sweet spot for their big trades. So I'll give a simple illustration. Let's say as you can see, you run a giant company and you want to buy 1,000 units of a product or something. You can't just walk into the store and say, "Oh, I'll take them all," or you can't just order them because you would actually spike the price and you cost yourself more money when you do that. Now imagine okay, let's do another imagination, another example. Imagine you are the one selling and then someone just comes to your place of work or whatever you are saying, I want to buy everything. And the person is really serious about buying everything. Even if everything was worth $100, because the person wants to buy it and he really needs it, you can say, oh, everything is $150. What have you done? You just added price. So to so the big players also, they face this issue of that when they buy in box, it affects, or sell in box, it will spike the price of the market, which is why they use algorithm, to engineer their entries. So they can't just buy and sell just like you and I. You and I, there's no amount of money we have that we can put in the market that can move it. So if they enter too early or too randomly, they will slip the market and they will get poor pricing. So instead, they allow the algorithm to engineer their entries. So institutional levels, they target psychological level numbers. Let me see that again. Uh, Round numbers are psychological in the sense that people think, oh, this is a good price. For example, if you are selling something at $100, okay, let's say you bought a product, you actually wanted to sell it for $97, but you just round it up to $100. I don't know if you get that. Or let's say, oh, this product you bought it for $20. Okay, and you intended to make profit of maybe $8. So to make your profit, you should sell at $28. But 30 is a round figure. So why not just sell at 30 instead of looking for change of $2? So people have that psychological idea that these levels, round figures, for example, on Euro USD 1.2000, is their institutional levels, or rather they became institutional levels because a lot of retail traders put their entries there or their stops there. So that became a reason why the institutions target those levels, or they use those levels as well. Some of those levels, round numbers, that is where they also what place their entries. Instead of entering at one arbitrary number, maybe 1.201, you just, or 1.205, they'll just enter at 1.2. I'm using Euro USD as an example. So this is these levels, they often sit at previous highs or lows. Yeah, you can find them inside other blocks or near fair value gaps, and they are actually pre-selected and engineered by the algorithm. They are not random support and resistance. Rather, they are carefully chosen levels, that let institutions enter or exit with the least disruption. And this is built into the algorithm itself. So when price approaches one of these areas that we have covered in this video, you should pay attention. You might be witnessing a large position loading or unloading. Now, these three ideas explain a lot about price behavior. They aren't just theories, like I said earlier. They are observable patterns in every market, every day. And once you learn to recognize them, you stop reacting to price and start anticipating it. And so, what's the secret to learning to recognize them? It's just practice. So, go over this concept again. Watch recharts and look for these patterns every day. Over time, you start to spot them instinctively. You can just, be looking at the chart, not necessarily to place any trades, but just to watch out for these things that I have said. So you keep studying. You can go back over this lecture and our chat. Practice on chat yourself. Try marking out liquidity zones and fair value gaps on on previous price historical data. Then when you want to trade with structure. So as I round up this video, have you noticed this price magnet in your own trading? Just let me know in the comments. If this helped bring clarity, hit that like button, share it with fellow trader, and don't forget to subscribe. Hit that like button. There's You are doing a lot by doing that. So we've got more deep dives coming on how the algorithm shapes price. Thank you for watching. See you in the next video.